We are well and truly launched into the reporting season now, and joining me to talk about what investors should expect is fund manager Roger Montgomery. Well, Roger, are companies going to impress us or disappoint us, do you think?
I think on an aggregate basis, Ticky, we're going to find that it'll be fairly disappointing. That doesn't mean share prices won't continue to go up. And that's because as interest rates fall, of course, retirees and investors are looking for better yields elsewhere, and lower interest rates drives them into equities. But the economic circumstances certainly don't justify higher prices at the moment.
So we've got looking forward to some more expensive stocks then in that case.
Well, as you know, we're value investors, and we like great companies when they're cheap. All the great companies are frightfully expensive. They're at nose-bleeding territory at the moment, particularly some of the IT companies and the internet retailers, the REA Group, realestate.com.au, car sales, for example, incredibly expensive at the moment.
Now, just a minute, Roger. These are precisely the companies that have stolen the rivers of gold from the print newspapers.
Oh, yes, and I'm not taking anything away from their business success. All I'm suggesting is that you're paying through the nose for that success now, and they're incredibly expensive. In the case of REA Group, it's trading at almost double what we estimate its intrinsic value to be, and we've done well waiting for things to be cheap, but it's just nowhere near cheap. So what we need to see is really impressive results from these high-quality businesses to justify current prices, to raise our estimates of their intrinsic values. But on an aggregate basis, the market looks expensive.
All right. Now, Roger, I know you don't like airlines, but bearing that in mind, let's talk about Virgin Australia, because they obviously had a glitch today in Sydney with their booking systems. But another profit downgrade. It looks quite challenging times for John Borghetti at the moment.
Look, can I just say the problems that have been cited are the acquisition of Tiger, the acquisition of SkyWest, the Sabre reservation system. We've heard of patchy economic conditions. The reality is this time is no different to any other time for Virgin. And if you look at the economics of this business, you would have put, if you started this business in 2003, you would have put $184 million of equity in and borrowed $139 million. You would have made a profit of $110 million in the first year. Fast forward 10 years, you're now losing $110 million, but you've contributed $800 odd million of equity, and you now owe the banks $1.7 billion. You might have hoped that over the last 10 years you would have paid that $139 million debt off that you had in 2003, but now you owe the banks $1.7 billion. This isn't a special time for airlines. It's always bad for airlines. You just shouldn't buy them. And it doesn't matter how hard John Borghetti rows this boat. The boat has a leak in the side of it, and that's airlines.
All right. Well, it's where you buy and sell on the cycle, I suppose, as we've said before.
Well, that's trading. That's not investing, Ticky.
Well, all right. Let's move to another company with a problem at the moment, and that's the New Zealand company Fonterra. And here is the largest dairy company in the world. And Australian investors can get involved through the Fonterra Shareholders Fund, which is ASX listed. But, you know, they have a scare like that, a big milk powder recall. And you sort of think to yourself, well, a big company like that, is this not a time to buy in?
Well, you're absolutely right. What you're looking for are great quality companies that fall on temporary bad times. And this is something they'll get past. Yes, their reputation might be hit in the short term, but in the long term, people have surprisingly short memories. And what may transpire, if someone gets botulism and they sue the company, then that'll be another temporary bad situation. But no doubt it'll be settled. They'll defend themselves, and the company will move on. So you're precisely right. This is one of those rare opportunities.
All right. Another company that's had a few blips in the last 12 months is Cochlear, but they've come in with some results today.
Yes, and what we see is everyone's focused on the profit result, obviously, and the profit result wasn't inspiring. But unit sales volumes are up 16%, revenue was up 2%. That's partly due, and in fact the majority of the difference is due to hedging losses, or if you like, a lower contribution from hedging of about $43 or $46 million this year compared to last year. What's interesting though is they've hedged about $140 million of US sales at 97 cents, and now with the Australian dollar below 90 cents, there's another loss for them this year. But I think they need to get their next Nuclear 6 device out in the marketplace. And what we'll find is I think a lot of the fears about the loss of market share will be relieved.
All right. Roger Montgomery, thank you very much for all that.
It's a pleasure, Ticky.